Hello, this is HarmanjotSingh. Today I'll be talking about the monetary policy of India. You might have heard about the term monetary policy of India in your economic class, because recently there were many changes in the monetary policy, like the introduction of monetary policy framework, monetary policy committee, and the change in the process of monetary policy formation. So let's first talk about why a country needs a monetary policy, who makes the monetary policy, and what is the purpose of the monetary policy. Monetary policy refers to the policy of the central bank in India, that is Reserve Bank of India, in matters of interest rates, money supply, and the availability of credit. It is through the monetary policy that RBI controls inflation in the country. RBI uses various monetary policy instruments, which we'll be talking about later in this video, like repo rate, reverse repo rate, SLR, CRR, etc. many to achieve the purpose. In short, if you want to say, the monetary policy refers to the use of monetary instruments that we talked under the control of the central banks to regulate the magnitudes such as interest rates, money supply, and the availability of credit with the view of achieving the ultimate objective of economic policy. So, what is the main goal of a monetary policy? The primary objective of monetary policy is to maintain price stability while keeping in mind the objective of the growth. Price stability is a necessary precondition to sustainable growth. Like India, which is growing at a good rate, we need a good monetary policy for that rate to continue. To maintain price stability, inflation needs to be controlled. The government of India sets an inflation target for every 5 years. RBI, which is a central bank, has an important role in the consultation process regarding the inflation targeting. The current inflation targeting framework in India is flexible in nature. If we talk about the flexible inflation targeting framework in India, now there is by the RBI Act of 1934, it is flexible right now. Current inflation targeting, the RBI has set is 4% plus minus 2. That is with an upper limit of 6% and lower limit of 2%. So the monetary policy framework. While the government of India sets a flexible targeting inflation framework in India, a flexible inflation targeting framework in India, it is the Reserve Bank of India which operates the monetary policy of the country. The framework aims at setting the policy rate, that is the repo rate here, based on the assessment of the current and evolving macroeconomic situations and the modulations of liquidity conditions to anchor the money markets at or around the repo rate. The repo rate changes transmit through the money market to the entire financial system, which in turn influences the aggregate demand, which is a key determinant of inflation and growth. So let's talk about the Monetary Policy Committee. The Monetary Policy Committee, which is required to meet at least 4 times in a year, constitutes of almost 6 people. Some of them are the governor of the Reserve Bank of India, the deputy governor of the Reserve Bank of India, one officer of the Reserve Bank of India, which has to be nominated by the central board, and there are 3 other nominated members. So let's talk about the monetary policy which has been formed on the above way, which we talked in the video, how to apply those frameworks. The monetary policy, it is done by the monetary policy instruments. There are several monetary policy instruments. We'll be discussing them. The first is the repo rate. What is the repo rate? It is a fixed interest rate at which the Reserve Bank provides overnight liquidity to the banks against the collateral of the government, like government securities and other approved securities, which can be treasury bills, etc., under the liquidity assessment facility, LAF. What is the reverse repo rate? It is the opposite, like the fixed interest rate at which the Reserve Bank absorbs the liquidity on an overnight basis from the banks against the collateral eligible of the government securities under the LAF, same government securities. So what is LAF, liquidity adjustment facility, which we talk about? The LAF consists of an overnight as well as term repo auctions. The aim of the term repo is to help develop an interbank term money market, which in turn can set market-based benchmarks or pricing of loans and deposits, and hence improve the transmission of monetary policy. The Reserve Bank also conducts various interest rate reverse repo rate auctions as necessitated under the market conditions. Now the fourth instrument, that is Marginal Standing Facility, MSF. A facility under which scheduled commercial banks, only the scheduled commercial banks can borrow and additional amount of overnight money from the Reserve Bank by going like dipping into their SLR portfolio up to a limit at a penal interest rate which has been pre-decided. This provides a safety valve against the unanticipated liquidity shocks to the banking system. Now, what is the bank rate? Another instrument. It is the rate at which the Reserve Bank is ready to buy or rediscount bills of exchange or the commercial papers. The bank rate is published by RBI under the RBI Act 1934. This rate has been aligned to MSF rate recently and therefore changes automatically as the MSF rate changes alongside the repo rate. There is a 100-point difference between the bank rate, repo rate and reverse repo rate. 100 basic points difference. What is cash reserve risiko? CRR? You might have heard that in the newspaper recently. The average daily balance that a bank is required to maintain within the Reserve Bank as a share of such percent of the net demand and time liabilities, NDTL, that is net demand and time liabilities, that the Reserve Bank may notify from time to time in the Gazette of India. Now, what is SLR? As the CRR, which has to be kept with the RBI, SLR is the same share of NDTL which the bank has to keep with themselves. The SLR is about 22% and the CRR is about 3 to 4% recently. Now, the last thing, which is open market operations. These include both the outright purchase and sale of government securities for injection and absorption of the liquidity. Like if there are more dollars in the economy, we can just supply the money and absorb the dollars, and if there are less dollars, so we can just supply the money, the reverse thing. To summarize the whole video, monetary policy refers to the use of monetary instruments which you talk under the control of the central bank to regulate magnitudes such as interest rates, money supply and availability of credit with the view to achieve the ultimate objective of economic policy. Thank you.